Goldman Sachs Apple analyst Rod Hall's with us. Lowered his iPhone sales estimates earlier in the week. Rod, it's always good to check in with you. Good morning.
Yeah, morning, Carl. Thanks for having me.
We got a nice, ongoing bull-bear debate when it comes to Apple. Morgan Stanley, of course, today says that maybe investors are hyper-focused on unit growth and that the guidance we're getting from these suppliers is nothing different than they told us on November 1st. What do you think?
No, I think things are a little bit different than that. I don't totally agree. I think that, we called out the potential for China sluggishness to drive weak earnings guidance back a couple weeks before the earnings. I don't know if you guys remember that, but, that turns out to have been the case. These recent supplier cuts, certainly some of those have been contemplated in Apple's earnings guidance. I think that's fair to say, but my suspicion, having done this for a long time now, over 12 years, is that probably not all of it is contemplated. It seems like we're seeing some indications that demand is weakening as we speak.
And so, Rod, I wonder how you look at Apple post iPhone unit numbers now. I'm starting to push on this idea that really the number we wish we had is annual revenue per customer, looking not just at the iPhone and the replacement cycle, but also the things in its orbit, including AirPods, including Macs, including things like Apple Music and other services. Is your belief that the lengthening iPhone replacement cycle trumps all those other things in the areas where Apple's trying to move the needle, at least for the next couple years?
Yeah, look, Tim Cook's commentary on the earnings call is that we ought to look at it as a grocery basket of products, and that we don't necessarily care what's in the grocery basket. The problem with Apple is the grocery basket has one thing in it, and that's an iPhone. So it's a single product company. It's very difficult to then say that, with any degree of, I think, confidence that we should not be looking at unit volumes and not be looking at the iPhone. And I think that investors will continue to try to focus on that. Remember, there's a lot of third-party sources for that data. So by removing that unit data, I think they may increase their volatility around the reports.
But Rod, I'm just going to dig into this even further because I feel like, and especially ahead of this most recent earnings report we got, you saw the stock trading at a higher valuation relative to its historical norms. And the whole story that everybody seemed to be coming on and talking about was services, growth in services, higher margin services. Does that actually go away or change?
Yeah, the services story gets put back in the microwave oven every time, we see any kind of weakness in iPhone units. So I'm not surprised to see that. I think the market, most people that do a lot of detailed work on services, including us, feel like we have a pretty good handle on where that's going. And my personal view is Apple's direct paid services like iCloud storage, music, these sorts of services, they've achieved very low penetration there, just over maybe 10% penetration of their active installed base. So there's a lot of work to go there, and they've been working at it for a while. So I think the services story, we see this coming back every time we have any weakness in the iPhone. I don't necessarily think that it's going to help the shares as we look into next year, unless that really does accelerate a lot.
Wow. That's a pretty harsh rebuke of the the razor blade thesis that so many have. You get this big installed base, and eventually you will see the downloads. Are you calling services a deflection from any iPhone unit weakness?
I don't think that, I don't know if what you mean by deflection there, Carl, but I think that services growth is going to be fine. I just don't necessarily think it's going to inflect positively from where the market expects it to be. That we called out a while ago that we think the TAC, for instance, from Google is $9 billion, higher than a lot of people think, and still growing pretty well, maybe around 20% growth every year. So there's still growth in services. It's just that, are we going to see some sort of a magical inflection of services next year? I don't think the data supports that view at this point.